First, though, we want to look at what's going on with stocks here today, because here, too, it's important to look back and then look at where we are right now. As we know, at this time a year ago, we were seeing stocks drop pretty precipitously. Today, the Dow opened at an intraday record. So pretty remarkable turnaround that we've seen in stocks, which of course are a forward-looking mechanism. The Nasdaq is also bouncing back today. It's up 1.9%. And Myles, what's interesting about that, of course, is that we've had this discussion now over the past few days. I mean, I think Stuart Kaiser put it really well in the last hour when he said a year ago, stocks were falling because we were worried about what was going to happen to growth. Now we're worried about what's going to happen to growth in the opposite direction, which has caused some recent turbulence in stocks. We've got stability over the past couple of days, but who knows if that's going to last.
Yeah, I mean, and as we kind of said right at the end of that conversation, things are a lot different when the S&P 500 is closing in on 4,000 versus when it's at 2,700. And it is interesting just watching, because there's kind of two stories now, right? We are back in the reflective mode of where things were a year ago, and I think as this chart illustrates, we can see how sharp that drop was. And in just under 2 weeks here, we're going to come up on the actual anniversary of the market low, and that was on March the 23rd, and we all remember how the next 2 months of conversations were a retest is coming. We're going to retest that low, and we really never even sniffed that level once we kind of launched off from there. But to take the local, concern here and how the market continues to act and work through this rotation, things were looking a little hairy over the last couple of weeks. The Nasdaq did dip into correction territory. There were a number of stats that I think many of us saw about how well the Nasdaq has performed after recent corrections. Well, with the exception of, March of 2000, every Nasdaq correction in the last couple of decades has been followed by higher markets pretty much over the next 6 and 12 months. And so with that in mind, with the rates backdrop continuing to be sort of reframed away from the reflexive high rates bad for stocks, I think we're getting past that point. More people understanding, Brian Sozzi, that higher rates can be fine for stocks. I think this has been a very constructive couple of days for the bulls, who maybe were on, maybe backpedaling just a little bit, at least, the tech kind of Momo plays. But the repair that we've seen happen in a lot of those names with the cyclicals continuing to grind higher. Again, I think just a very constructive backdrop here for the markets.
Right, Myles, you've seen really the resumption of the everything rally, and I guess that's good while it lasts. But within a rally like that, you could see absolute disasters. Look at Stitch Fix earlier in the week. Stock was down over 30%. Really disastrous quarter, disastrous earnings call. And then today, look at Bumble. Shares up about 11% here in the early going here. A good quarter, accelerating revenue growth, hopping on an earnings call and actually giving guidance that you might be able to deliver upon. So I know investors appear, maybe they want to chase everything right now because they fear as though they have to, but I still think picking individual stocks is very important always, but no more so than right now. There are going to be a lot of disasters out in the market over the next few weeks, especially as we get back into earnings season again. Choose your investments wisely.
Saz, what I would say, though, is that's a return to normal of a sort, right? That's in any market environment. If you are invested in a company that has gone up, like a Stitch Fix that's gone up, 2, 3, 4x in the last several months, and they come into a soft-ish quarter. Look at Oracle this morning. You come out with a light guide, you're going to get punished for that. That's very much normal market behavior. And I think, Julie, perhaps a nice return to some normalcy in financial markets after a time when either everything went up for no reason or everything went down for similarly indiscernible reasons. At least that's kind of how it started to feel, let's say, May of last year and almost up until today.
I mean, you could still argue there's still some wackiness in terms of magnitude, at least, right? Look at Roblox yesterday, and it's
GameStop,
it's
totally normal fundamental story.
Yeah,
So nothing going on there.
I do want to dig a little bit more into Oracle, but first I want to mention a couple of other records that we're watching today. We mentioned the Dow Industrials at a record. The transports are also at a record, but the small caps are at a record too. Russell 2000 at a record high here today. And then we've got other sort of ETFs that we watch as well, like the XHB, which tracks home builders, that's at a record. I think that's interesting too, given the demand for housing that we have seen. Okay, as for Oracle, a company that reports something the market doesn't like, is falling, to your point, Myles, sort of return to normalcy. And that's something that the market seemed not to like was its forecast, because we have seen such hot growth from so many of these tech companies, and the company now talking about in its last quarter, revenue up by 3%, which was in line with estimates. Constant currency sales were actually flat. And the company says, growth this quarter is going to be pretty much the same. So when you're talking about all of these growth companies, the pressure's on even more to deliver growth. And, 3% ain't it.
Yeah, Julie, the only thing I really was interested about with this Oracle quarter is what Larry Ellison, really, that's always the case for me. I always love listening to Larry Ellison on these earnings calls. What he had to say on the call last night about SAP. He went down a whole long list of business that the company is stealing from SAP. And maybe there's been some commentary recently that SAP is taking business from Oracle and who's signing up for Oracle's cloud. Really, Larry Ellison dropping the hammer and really a long rant. I think it was pretty hilarious. And I would encourage everyone to read that transcript on Yahoo Finance. It's worth your time.
And moving on to one, speaking of another meme stock that we were watching that actually had fundamental news, talking about AMC, the movie theater chain. That company posted a loss in the fourth quarter that was actually smaller than estimated. And probably more importantly, talked about its cash and liquidity position, which it says is sufficient in the near term to keep it in business. It talked about reopening of its various theaters and perhaps return in ticket sales, so that the outlook is getting better. Los Angeles and New York is where it is seeing some of those theaters open back up. I don't know. You guys ready to go to a movie? I think I'd go to a movie theater at this point if it's not crowded, right? It's a big place.
Yeah, I mean, look, AMC, the meme stock, you can see the meme life of the thing. I mean, it's not hard. It doesn't take a genius to find it on this chart here. That's a big part of the story here. But that was kind of kicked off by the company very forcefully at the beginning of this year, coming out and saying, we will not be going out of business. Now, I don't know if that's the kind of thing that sends a stock normally from 1 to 10. I think there's still a lot of questions about what the growth trajectory of the movie-going business will be on the other side of this. The streaming questions, the way studios have started to find middle ground, although I don't think the theater would think it's middle ground at all, with release on streaming and what the exclusive window is there. But Julie, I think to your point, personally, I'm not a huge movie theater person, but I know people who are, and they are hardcore jonesing to get back into theaters on a very regular basis. And I don't think that once we get to, let's call it June, July, pretty much anybody who wants a vaccine will be able to get one. I don't think there's going to be any lack of demand for what AMC is selling. I think their bigger question going forward, once we get past, the next, call it 12 months, is how they deal with these streaming release windows and what kind of precedent that has been set. But that's the existential question that they've been asking for years. I think clearly the concerns of them going out of business have very much been put off here. And again, the meme thing is just a hilarious kind of sideshow for the company's corporate history as well.
Yeah, definitely.